QuotedData's weekly show. I'm Jayna Rana, and I'll be sharing this week's top investment trust news stories before my colleague Richard Williams will tell you what's going on in the world of REITs. He will also be interviewing our special guest, Jason Bagley, who is the manager of Standard Life Investments Property Income Trust. So as you can see, this week we'll be talking about Electra private equity, JLEN environmental assets, HydrogenOne capital growth, and abrdn European logistics income. So first up, Electra private equity earlier this week announced it will rebrand as Unbound Group and relist on the alternative investment market. The business will switch to an online multi-brand retail platform designed to support the lifestyles of those in the 55+ age demographic. Its last day of dealing as Electra will be on the 28th of this month, and it will relist on AIM from the 31st of January. So the main business will be Hotter Shoes, which you'll probably recognise as one of Electra's key holdings, but the group said it will expand beyond footwear with a focus on apparel, wellness and lifestyle products and services. Ian Watson, who's the current CEO of Hotter Shoes, will become the chief executive of Unbound Group. So a bit of background to Electra, which I'm sure is a name that you all recognise as one of the oldest private equity trusts. It's just shy of 50 years old. It's had a bit of a busy history over the past decade or so, as it was targeted by activist investor Edward Bramson of Sherborne Investors back in 2015. After a strategic review in 2018, it announced a managed wind down, and in 2020, it said it was aiming for full realisation of its assets by the end of 2021. However, last year it confirmed its demerger plans for a number of its holdings, including that of Hostmore, which many of you will know as the trading name for TGI Fridays, and the transition to AIM to create the Unbound Group. So just looking over Electra's share price over the past 3 years, so this is after the announcement of the managed wind down, which was in 2018. As you can see, it was relatively stable as assets were being sold, but of course the share price took a big hit as COVID popped up in 2020. This is largely because as a hospitality venue, TGI Fridays, of course, had to close its doors. The price slowly climbed back up over the rest of the year in the first half of 2021, but plummeted in October last year after it released its update on the Hostmore demerger plans. You can also see this is reflected in the company's discount levels. So a bit about Unbound Group and what it plans. So the main thing is that, as already mentioned, it's addressing an audience which it believes is materially underserved online. That's those in the 55+ demographic. Electra says that it's a group that's rapidly becoming more internet savvy and more focused on their well-being and their desire for comfortable living. It also notes that there is a higher concentration of wealth in this demographic, which means a focus on value rather than price. So developments are already underway, negotiations are taking place with new brands to join the group, and Unbound is aiming for more than half of its profits to come from names outside of Hotter Shoes, and it expects to share figures by next quarter. So next up, looking at JLEN environmental assets. Of course, subject to shareholder approval, it's hoping to launch a placing and an offer for subscription for new ordinary shares in the company of no par value at 101 pence per share. This issue price represents a premium of 2.26% to NAV on 30th of September last year, and a discount of 2.7% to the closing share price on the 11th of this month. JLEN is currently 109 million drawn on its revolving credit facility, and it hopes to use the net proceeds from this placing to repay this and to fund a pipeline of environmental infrastructure opportunities. Again, some background on the trust. It was launched in 2014, so it's still quite young, but it's actually one of the older names in the renewable energy infrastructure sector, which I'm sure you're all aware has been buzzing over the recent years. It currently offers a very attractive yield of 6.67% and is trading on a premium of 3.47%. It has a market cap of 613 million. So again, just looking at its share price over the past 3 years, you can see, like Electra and probably every other trust in the investment trust world, it was hit by COVID in early 2020, but it did bounce back just as sharply, as you can see. And looking at the discount level, like most of its sector peers, JLEN has generally traded on a premium, which has often gone into double figures. You can see around the middle of last year, after it suffered during the height of the pandemic, its premium actually exceeded 20%. So just looking at the pipeline that it mentioned, should it raise enough funding, JLEN is looking at 4 areas in particular. The first being anaerobic digestion, which is currently its 2nd largest sector exposure and one which has significantly outperformed. Controlled environment agriculture, which the company says is as a growing global population will increase food demand, and using the current agricultural practices is a challenge. So it says controlled environments are more efficient and use up to 95% less water. Low carbon and energy efficiency, so this includes electric vehicle charging infrastructure and battery storage assets, which offer good growth potential. And finally, biomass, which JLEN actually acquired its first biomass asset last year, which has already performed well. And so it's looking at a number of other operational biomass plants across the UK and Europe. Finally, we have HydrogenOne capital growth. So no formal announcement yet, as with JLEN, for a particular type of fundraise, but HydrogenOne capital growth has expressed its interest in doing so. It says it's excited about the progress within the sector with developments in policies and the like. For example, the phase out of diesel in UK heavy goods vehicles by 2035 to 40 further supports the hydrogen sector. The company's also identified an investable universe of more than £17 billion and over 200 opportunities, many of which are within the private sector. So like JLEN Environmental Assets, HydrogenOne is in the renewable energy infrastructure sector, but it's much younger. It was launched only last year in July. You may or may not have followed the IPO, but it actually aims for £250 million, but missed its target, raising only £107 million. Despite that, it has performed well and is currently trading on a premium of 17%. It's also deployed 46% of its net proceeds from the IPO, including 19 listed positions, which represent 9% of the initial proceeds, and 3 private positions, which represent 37% of the proceeds. So again, just looking at its chart, we can't go back a full year because it only launched in July. But you can see it's gone down slightly, but as it's invested into new names, it's been a bit more stable. And as already mentioned, it's on a very high premium that's in the mid-20s currently. So passing over on to Richard.
Great, thanks, Jayna. I will, give me a sec, I'll just share my screen. Sorry about this.
Oh, we just saw it for a second there.
Yeah, sorry, I'm just having a bit of issues here, one sec. There we go. Cool, there we go. Sorry about that. So yes, Aberdeen European Logistics Income announced this week that they're proposing a placing under their share issuance programme. It'll be at 110 pence, which is a nice premium to their most recent reported NAV of 4%, and it's open to private investors via primary bid, which is always good. And that will close on 1st of February. And it says it's got a near-term investment pipeline worth about 142 million euros. It's in negotiations on 4 assets, 3 in France and the other in the Netherlands, which is about 50 million. And it will also use the proceeds to fund the development of an Amazon pre-let warehouse in Madrid, and also fund the extension of one of its current assets, which is pre-let to the current tenant in the Netherlands. And a small sum, about 15 million, will be paid. Will pay down their revolving credit facility. It recently raised, you may remember, in September, 125 million, which was used to acquire this massive portfolio in Madrid for 227 million. Urban logistics dotted around Madrid city centre. 7 of the properties are already built and let up, and 1 is a development which will be this new funding will fund, and that's pre-let to Amazon. It's let to 5 tenants. Amazon is the biggest one. They make up 43% of the income. There's also Carrefour and electric vehicle make a rival in that portfolio. All of the leases are inflation linked, and just showing the last mile sort of urban logistics merit of this portfolio. 6 million people are accessible in a 30-minute drive, so it's really sort of core central, or as central to Madrid as possible. So that's quite an exciting acquisition, and they say they've got many more sort of things like this lined up, so are looking for more money. It's a bit of a change in strategy for them, because over the last few years they've been raising small amounts, buying one property at a time, paying down sort of debt with the money they raised and things like that. Whereas now they're looking to raise a lot more money in one hit and go on the acquisition trail. Maybe that's the influence of Aberdeen buying a majority stake in Tritax, who now sort of run their European real estate. Maybe that's what's happened from there. But it's an interesting move, and you can see this is their performance table since they launched in 2018, or back end of 2017. Been on a healthy premium since after the COVID jitters, which was quite high at one point last year, but it's come down to a more sort of sustainable level of about what we're on 1.1% at the moment. So it's a decent value to have there, given the growth that's likely to come. Its current portfolio, 24 assets in 5 countries, valued at 746 million, 50 tenants, and Amazon, once they complete this pre-let of the new development, will be 10% of their income there. That'll be their biggest tenant, and all of their leases are inflation linked, so there's some protection there on the big inflation that we're getting at the moment. And this, just a roundup of the sector really, for those that are unfamiliar with the logistics sector. It's continuing to outperform all the other property sectors. Demand is driven by growth in online retailing, but also tenants and businesses and manufacturers and stuff strengthening their supply chains since sort of the COVID hit, and we had this Suez Canal incident. There's been a lot more focus on supply chain resilience, so that's bringing back manufacturing plants closer to the end user, so in Europe from the Far East, and also increasing their inventory levels. So the impact that has had is a record take up last year, and a forecast for much of the same this year and next few years going forward really. And coupled that with the severe supply constraints in most of the European countries, as you see there, 4.6%, but that's much more acute in some of the more prominent markets. That has led to significant rental growth over the last few years, and forecasts for the few years to come. And investors have obviously been on top of this, piling into the sector. Last year, investment in European logistics was 64% up on 2020 and double the 5-year average. And a lot of the markets are now at sub 4% yields. So really interesting times for the logistics sector, a lot more growth to come. So it'd be interesting to see how much ASLI raises in the next few weeks. So I think